About 20 years ago, when I opened my first ANZ account, I remember the comfortable lounge, bright office, and smiles on the face of the ANZ Bank manager. The entire process was friendly, thoughtful, and pleasant even though I didn't have much to deposit as a student. Nowadays, when I use ANZ business accounts for my own legal practice, I'm unimpressed about its lack of human services and miscommunication between departments. Just a couple of weeks ago, it took me literally 2.5 days and speaking with 6 different people to complete an international telegraphic transfer. The main reason is that their business account department did not communicate with international transaction department. So when there is a profile update, for example, change of address, the data was not synced between the 2 departments, causing problems and delays. And how many of you are using ANZ Wordline F-TOPS machines? Pay attention to this. When there is a fraud of credit card use and the money is returned to the innocent card owner, ANZ Wordline will also claw back the funds from business owner's account, even they have already sold the goods. Even worse, when you would like to complain against the financial regulator AFSA, you will be told that ANZ Wordline is not a member because ANZ Wordline is not a subsidiary to ANZ. It is only a third payment solution business and is operated independently under a joint venture arrangement. One of my clients was a victim of fraudulent credit card usage and lost their goods sold to a person who used others' credit card. But ANZ Wordline clawed back part of my client's savings and demand recovery of the balance. No matter how many times my client explained to ANZ Wordline their circumstances and financial difficulties, ANZ Wordlines come back with the same response, asking for repayment, as if they had never received the complaint. Another terrible example is that one of my clients intended to acquire a multi-million-dollar property using his savings in ANZ Plus. But the week before settlement, he was told that he could not withdraw all his money from ANZ Plus, as he can only transfer the money from his ANZ Plus to ANZ saving account with a daily transfer limit of $25,000. So for a $2.5 million property to be settled by cash, the client theoretically needs to withdraw the money for 100 times, and it takes over 3 months to get his money back to complete the acquisition. Since ANZ Plus is a digital-only banking service, no ANZ staff at any branches will help him, so he had to spend hours complaining over the telephone, eventually give up and had to borrow money elsewhere to complete the transaction. All these unpleasant experiences is only a tip of iceberg and is dwarfed by what we are going to review today: misleading the federal government, ignoring thousands of hardship pleas, and paying savings interest, and charging fees to the debt people. Australia's 4th largest bank has now admitted widespread misconduct, and together with ASIC, will ask the federal court to impose $240 million in penalties. Total penalties are the largest announced by ASIC against one entity. We will discuss the story behind these cases, what ANZ admitted, how those systematic failures occurred, and what are the changes to be made in banking industry. On 15 September 2025, ASIC announced that ANZ had admitted serious breaches across its institutional markets and retail divisions. ASIC and ANZ will jointly ask federal court to impose $240 million in penalties subject to the court's final approval. ASIC says the conduct shows years of failure to manage non-financial risk and impact nearly 65,000 customers. And in one case, the Australian government itself. ASIC filed 4 separate proceedings, each supported by a statement of agreed facts and admission, which are a set of formal documents where the parties agreed the facts for the court. Those 4 matters were firstly, unconscionable conduct during a $14 billion government bond issuance and misreporting secondary market turnover. Number 2, failures to respond to hundreds of customer hardship notices, in some cases for over 2 years, and failing to have proper hardship process in place. Number 3, false or misleading savings rate promotions, and failures to pay promised interest to tens of thousands of customers. Number 4, charging fees to thousands of debt customers, failing to refund those fees charged, and not responding to loved ones trying to deal with deceased estates within the required timeframe. What exactly did ANZ admit? Let's unpack each case. The first case is about bond deal and misreporting. On 19th April 2023, while assisting the Australian Office of Financial Management on a 14 billion bond issuance, ANZ sold a significant volume of 10-year bond futures around pricing, putting downward pressure on bond price. ANZ didn't disclose to its government client that it still had significant volumes to sell or offer a chance to delay pricing. Such conducts were against ANZ's representations made to the government that its key objectives were, firstly, smooth execution, secondly, minimal market movement around the time of pricing, thirdly, transparency, and fourthly, acting honestly and with integrity to manage conflicts of interest that could arise between ANZ and its clients. Here, conflicts of interest arise because, being the manager, ANZ accepted the significant risk associated with 10-year Australian bond futures, and ANZ was expected to sell 10-year bond futures to pre-hedge the anticipated risks. ANZ would receive no fee or spread for accepting the risk of acquiring the significant number of 10-year bond futures. It would only make a profit or loss from the difference between the price at which it acquired the bond futures from investors and the price at which it sold an equivalent volume of those contracts in the market during its hedging. As a result, each basis point reduction in the price of 10-year bond futures at pricing and the consequential change in the yield of the bond would, firstly, disadvantage the government because it would reduce the proceeds from the bond issuance, and secondly, benefit ANZ because it would pay a lower price to acquire the bond futures from the investors. When it comes to selling strategy, the least risky approach for ANZ is sell at the risk in as small as possible a window just around time of pricing. However, this course of action would disturb the market. The converse would be ANZ selling the risk over a period of days leading into pricing. This would enable a smooth execution with very little impact to the market, but would expose ANZ to very material market risk. The correct approach, therefore, lies somewhere in the middle. We won't go any further as to ANZ's trading strategy, but in a nutshell, on 19th April 2023, ANZ determined to sell about 65,000 contracts of bond futures in less than 2 hours, knowing that such selling would have a downward impact on the price of the bond futures, and did not inform the regulator in advance about its trading strategy. As a result of those transactions, the expected issuance size of 10-year bonds was between 14 to 15 billion, while it ended up with about 13.16 billion. ANZ earned approximately 10 million revenue at the cost that Commonwealth suffered loss. ANZ also misreported turnover data for almost 2 years, overstating volumes by tens of billions of dollars used in dealer selection. ANZ at the time was keen on managing the Treasury bond issuance because that would help them set off their previous losses and present themselves as the market leader in the Australian bond business. These inflated figures about turnover made ANZ more attractive and helped the government select ANZ as the dealer for bond issuance. ANZ has admitted unconscionable conduct and misleading the government, and it accepts a combined 125 million penalty as appropriate, including a record 80 million for unconscionable conduct. Now let's look at the second case about financial hardship notices. Between May 2022 and September 2024, at least 488 customers lodged hardship notices. Some even waited over 2 years for any response. For some of you that don't know, as a customer, you do have the right to request a financial hardship assistance, including change the credit contract, payment extension, or debt forbearance. Hardship obligations also arise under the National Credit Code, including time limits to acknowledge and decide hardship requests. Instead of properly responding to the customer's pleas for hardship, ANZ sent default notices, demand notices, or even refer customers to debt collectors without responding to customers' hardship notices. ANZ admits contraventions, and ASIC is seeking penalties. The third case is about bonus interest and misleading savings rates. From 2013 to 2024, ANZ promoted introductory bonus interest, but systems didn't always apply it. ANZ remediated 190,000 accounts as a result of this issue. Then between August 2024 to March 2025, ANZ's website promoted base and bonus rates that were found out to be inaccurate, impacting over 56,000 customers. 26,000 were unpaid, around 480,000 in interest. These issues were first discovered through a review undertaken by an external firm. ANZ admits misleading conduct and failures to pay promised interest and says that they will remediate the customers. Then the fourth case is about diseased estates. From July 2019 to June 2023, ANZ failed to refund fees charged to thousands of diseased customers and did not respond to their representative within required timeframes. This is because ANZ's system could not identify which fees should be waived or refunded. ASIC notes the full number affected is unknown. Over 18,900 accounts have been remediated, 3.8 million so far for unintended fees and delay-related costs. The Federal Court has listed 2 hearing days by consent: 2nd December 2025 for the markets matter and 3rd December 2025 for the retail matters. The court will consider declarations, penalties, and other relief, and decide whether the proposed total $240 million is appropriate. What outcomes are likely? Based on the filings and ASIC announcement, pecuniary penalties for each proceeding, totaling $240 million if approved, can be expected. Potential adverse publicity orders in at least one retail matter are expected to be granted. There could also be compliance and ancillary orders, for example, risk management and remediation undertakings, which are consistent with ASIC's originating process. Penalties are not final until the court makes orders. So why this case is so significant? ASIC says this is the largest proposed penalty it has ever announced against a single entity, reflecting serious and systematic breaches across both wholesale markets and retail customers. It ties into a longer pattern of enforcement and has significant implications for Australian clients, markets, and government. These implications include, firstly, trust and non-financial risk. When a bank misleads its own government client about 14 billion bonds issuance and overstates market activities, it undermines confidence in sovereign funding process. In the bond trading case, ANZ was trusted by the government, and its misconduct had the potential to reduce the amount of funding available to the government. This funding is used to support health and education systems, affecting all Australians. As mentioned by ASIC Chair Joel Longo, when public funds are put at risk, every Australian pays the price. Secondly, everyday customer and culture issues. Failing to apply promised interest, ignoring hardship requests, and charging the deceased are symptoms of culture and system weaknesses. As one of the Australia's leading financial institutions, this sets a bad example. As stated by John Longo, there are fundamental issues with ANZ's risk and compliance culture, and such root issue must be fixed. Thirdly, it's a regulatory message to industry. If the court approves these penalties, it will signal that compliance isn't cost of doing business. Expect more data-driven supervision, diverse publicity orders, and board-level accountability across the sector. Over the last decade, ANZ faced various negative publicity and penalties. Starting from 2012, in Andrews and ANZ case, the High Court ruled that ANZ charged unlawful penalty against thousands of its customers. In 2017, ANZ was ordered to pay a $10 million penalty for attempting to manipulate the bank bill swap reference rate on 10 occasions over a period of 18 months. In 2018, ANZ was ordered to pay $5 million penalty for failing to verify customer income in its former car finance businesses. In 2020, ANZ was ordered to pay a $10 million penalty in relation to over 320,000 instances of unconscionable conduct over periodic payment fees charged to its customers. In 2022, ANZ was ordered to pay a $25 million penalty for failing to provide promised benefits to customers with offset transaction accounts or under a break fee package over 20 years. In 2023, ANZ was ordered to pay a $15 million penalty for misleading customers about their available funds for certain credit card accounts, resulting in fees and interest charges. In the same year, ANZ was also ordered to pay another $10 million penalty for accepting information and documents from unlicensed third parties in its home loan introducer program. And this list may go on. As stated by ASIC Chair Joe Longo, time and time again, ANZ betrayed the trust of Australians. As one of Australia's biggest banks, customers trusted ANZ to do the right thing, but even on the basics like paying the correct interest rate, it fell short. So where do we go from here? What changes are we expected to see? Let's be frank, this case exposes both serious failures and some silver linings. On the negative side, ANZ's misconduct shows deep-seated culture and system problems. This mirrors global patterns. For example, in the US, the Wells Fargo's fake account scandals illustrated how high-pressure sales culture and weak oversight can create systematic misconduct. In the EU, the European Systemic Risk Board's report found that the bank misconduct risk is a serious macroprudential issue. On the positive side, the fact that ASIC and ANZ resolved 4 separate proceedings by consent and asked the federal court to approve the outcome signals an enforcement regime that is active and moving from investigation to resolution. Additionally, this outcome adds reputational and regulatory pressure on ANZ to reform as the bank's new leadership acknowledges the culture change required. It is notable that ANZ has engaged constructively with ASIC in advance of the proceedings being commenced, including by making admissions in relation to its conduct at the earliest available opportunity and acknowledging liability. As a result of these conducts, ANZ helps speed up the proceedings, assist with remediation process, and save taxpayers' costs on years of litigation. Since 2018, Australian regulators and public have demanded faster remediation, honest admissions, transparent cooperation, and cultural accountability. Banks now know that public perception, shareholder confidence, and political pressure are far more punitive than fine. ANZ's leadership is conscious and smart this time of avoiding another reputation-damaging scandal like CBA and AMP in 2018. This could set a higher benchmark for banking conduct globally. A bank will almost always prefer a controlled settlement over a public courtroom bloodbath, especially that evidence nowadays is largely digital and irrefutable. Do you think a $240 million penalty bill is sufficient to change a bank as large as ANZ? Or is it simply a cost of doing business? In your experience, do banks genuinely treat customers better after major scandal being reviewed? Or is change mostly cosmetic and temporarily? And what reforms do you want to see from the banks? Let me know your thoughts, and thanks for watching. I will see you next time.